Hey everyone, and welcome to today's Explainer. We're looking at Microsoft. Look, if you've been following the markets even a little bit, you already know the stock has been on an absolute tear, up over 30% in the past year. They are basically dominating this new AI frontier with total authority. But you know, a massive run like that creates some real tension, and that is exactly what we need to unpack today.
Because it all boils down to one simple yet incredibly difficult question. After a rally this huge, is Microsoft a buy, a sell, or a hold right now? Okay, let's dive into it.
Here is our roadmap for the analysis. We'll quickly hit the short-term technicals, dig into the long-term AI fundamentals, check out Wall Street's consensus, outline the key bear case risks, and finally, give you the ultimate investment verdict.
All right, starting with part one, the short-term technical setup and the immediate hurdles.
So we're starting with a dose of short-term caution just to ground us in reality here. Right now, Microsoft is trading directly into a major resistance zone, right between $510 and $513. And this specific level has rejected the price multiple times over the last few months. Plus, options flow is suggesting that market makers are in what we call a pinning regime. Basically, they're capping the upside right near that $510 mark. So if you're a short-term trader, you really need to be careful about chasing the stock at these levels. Honestly, you're much better off waiting for a clean, high-volume breakout or just waiting for a dip to the lower support at $475, or even the major support down at $435.
And this cautious stance is backed up by another technical signal. It's actually kind of fascinating how perfectly the concept of bearish divergence applies to Microsoft right now. The Relative Strength Index, the RSI, is pushing up over 70, so it's firmly overbought. At the same time, the MACD indicator is showing that bearish divergence, meaning the price is making higher highs, but the underlying momentum is actually trailing behind, making lower highs. It is a textbook signal of exhaustion. It tells us that without a fresh surge of volume, the most likely immediate path is a pullback.
Okay, let's move to section 2, the long-term AI fundamentals, or the underlying engine of this company.
So we've looked at the short-term hurdles. Now let's flip the coin. Because the long-term fundamental picture for Microsoft, it is absolutely unequivocally bullish. Just look at this number, 43%. That represents Microsoft Azure's year-over-year growth in constant currency. That was a massive beat on their earnings. But honestly, it gets even better, because management is actively guiding for 45% growth next quarter. So this underlying engine, it is not slowing down. It is literally accelerating.
A huge driver of that growth is their strategy around AI infrastructure, which relies heavily on something we can call dual-use hedging. Get this, Microsoft is projecting a staggering $190 billion in data center capital expenditures for fiscal year 2026. $190 billion. But the real genius here is that these data centers are dual-use. They're designed to handle massive AI workloads, sure, but also standard traditional cloud computing. So that massive spend acts as a built-in safety net. If AI demand softens even a little bit, Microsoft can just smoothly pivot all that computing power right back to standard Azure growth.
Now, to really grasp the certainty of their growth, we have to talk about RPO, or Remaining Performance Obligations. To strip away the finance jargon, RPO is just future contracted revenue. It is essentially guaranteed money in the bank from long-term enterprise contracts that are already signed, sealed, and delivered.
And the sheer scale of Microsoft's RPO is mind-blowing. It's $392 billion. Let that sink in for a second. When you're sitting on a $392 billion cushion of guaranteed future revenue, suddenly trading at 28 times forward earnings actually looks like a totally reasonable premium to pay for a company that is arguably the best positioned in the world to monetize the AI revolution.
Moving on to section 3, Wall Street analyst consensus. Let's step into the echo chamber.
With fundamentals that strong, you naturally have to ask, right? Do the top pros on Wall Street actually agree? Well, out of the 39 top analysts covering the stock, all 39 of them have given it a buy or strong buy rating. That is literally a 100% completely unanimous consensus. Wall Street clearly isn't sweating Microsoft's massive AI spending. They're viewing it as a highly lucrative long-term investment, not some sunken cost.
So let's break down what those analysts are actually projecting. The average price target across the street sits at 563, implying about a 12% upside from where we are now. But the heavy hitters, they see a lot more room to run. Citi just upgraded their target to $600, aggressively citing that massive Azure beat. Morningstar maintains a $600 fair value, giving Microsoft their coveted wide moat rating. And Bernstein goes even further with a super ambitious $660 target. They argue that the whole bear case about AI overbuilding is just flat out wrong, pointing out that Microsoft's infrastructure expansion is actually growing slower than their cloud revenue. Talk about a fantastic problem to have.
All right, Section 4, the key bear case risks. It's time for a quick reality check. Look, while the fundamental story is incredible and Wall Street is cheering them on, any responsible analysis means we have to respect the potential downsides, right? There are 4 main threats here. First, valuation multiple compression. If AI growth slows or misses expectations, the stock could stay flat or drop even if earnings are growing. Second is the fierce competition from Google, Amazon, and even OpenAI eating into Microsoft's first-mover advantage. Third, there's the execution risk of that $190 billion spend. If the return on that investment lags, the market is not going to be forgiving. And finally, that technical pullback we talked about earlier. A 5 to 10% correction is totally on the table, just based on how overbought it is right now. Are these immediate deal breakers? No, but they are very real threats that we have to keep in mind.
And that brings us to Section 5, the final investment verdict and what to do next.
It is time to bring our short-term caution and long-term conviction together into one clear framework. And really, it comes down to a bifurcated strategy. If you're looking short-term, the strategy is to wait. The stock is stretched right now. New buyers should be patient and look for that target ad zone between $435 and $475, where the risk-to-reward ratio gets way more attractive. But if you're talking long-term, it is a strong buy. If you're investing for a 3 to 5 year horizon, this is quite frankly one of the highest quality compounders in the entire market. If you already hold it, you should absolutely stay put and just hold through the short-term noise.
The AI thesis, that absolutely incredible Azure growth, and hundreds of billions in contracted revenue make Microsoft a definitive long-term winner. But the immediate technicals, they demand patience. So I'm going to turn it over to you. Are you willing to pay the premium today for a definitive long-term AI winner, or do you have the patience to wait for the technicals to give you a discount? Keep analyzing, keep learning, and thanks so much for joining me on this explainer today.